Hello, everyone. My guest today is Derek O'Carroll. He's building Brightpearl, which he joined 3 years ago. He took on the biggest risk any CEO could take, a turnaround, and not a pretty turnaround, a big turnaround. Since taking the helm as CEO, he's led the retail operations platform from stagnant growth to more than $12 million in revenue, nearly 1,400 customers worldwide, and managing more than $3 billion in orders. Derek, you ready to take us to the top?
I am, but all that data that you just gave me is from a number of years ago.
So here's why
That's our O.
here's why I read it. I'm setting you up to undersell, over deliver.
Oh,
So where
sorry, man.
so where are you now today?
We're at $18 million in our. We're at just over 850 customers, but I'll explain why we've got less customers now. And we're clipping along at about 40% R growth per annum,
Wow.
and we expect to be at 25 this year. And all of the leading indicators from a SaaS business of good, healthy unit economics are there.
So it sounds like you've gone through some sort of motion of churning off smaller ARPU accounts and going enterprise, which is why customer count's gone down. Walk me through the actual product. What are you upselling to enterprise accounts to drive expansion revenue?
Okay, so selling to larger customers, the exact same product, but it's been conditioned to be able to support much, much larger volumes. So we invested in infrastructure, security, and customer success to be able to handle much higher volumes. So in the main, the product is pretty much the same as it was 3 years ago, with some areas of innovation, in particular around automation and native connectors to platforms like Shopify. And through that route, we were able to generate a lot more value to the customer and drive AOV. Over the 4 year period I've been here, AOV has gone up 588%, and it's now at 38,000 per year on a per account basis. That's subs only, not implementation.
How do you measure AOV? Is that just on the sign up, or is that an average over like what you upsell them over the whole first year period?
No, it's just on the sign up. It's average order value for a new contract. So it's new contract value, I
Yep.
suppose, in other parlance. And it's subs only, so no PS. So average professional services for implementation is about $18,000 per new customer, around 18 billable days.
Yep.
And customers go live. We're clipping along at about 110 days in the last 12 months, in the last 12-month period. And that's calendar days. So that's from when you sign to when you go live, which in comparison to the sort of legacy ERP systems like SAP or NetSuite, they're typically about a year or a year and a half.
Derek, a lot of the entrepreneurs listening right now are going, I'd love to do professional services. I'd love to do a setup fee, but my VCs won't let me. They don't like the low margin profile of professional services. You've done it. It's working. What advice do you have for them?
Well, at the end of the day, we're in B2B software, so it's complex by its nature, and it's people and software, and you need individuals who've got expertise to bring people along the journey. If you don't get people up and running. And I think the key number that we look at is pre-live and post-live churn. If you don't get professional services right, you see pre-live churn spike, which obviously impacts your universal churn. And then post-live churn, you want to drive down below 10% and get to sort of 4% and be super sticky. And that's why professional services and the customer success journey post-signature is so, so important. So if you look at it in a just individual scope of PS, and it's not margin rich, you're actually missing the wider picture. So you got to think end to end.
Mm-hmm. When we spoke back in 2018, you articulated that gross churn annually on a revenue basis was about 13%, but expansion was 15%. So you had above 100% net dollar retention. Where's that today?
We're at still 13% churn, and DRR is at 102%.
I've never
So
heard
it's the
that.
same
I've never heard that. What did you say?
dollar retained revenue. It's the same
Ah.
number. It's sort of how much we're selling on top of what we had last year. And when you look at that 13% churn, about 4 points of that, 5% of that is coming from what we call failed implementation. So customers that go off spec, have issues, have people churn, underestimate training requirements, whatever it is, and then they get to the 12-month cycle and they don't want to repay again. So that's what pre-live churn is.
Mm-hmm. And then, sorry, I cut you off. So the net dollar retention number, or your DRR, is 102.
Yeah, it's 102%.
I mean, so is there a path to drive that up? Is that an initiative for 21? How do you get up to like 110, 120?
So over the last 3 years, we've put in place utility-based pricing, which essentially links our customers to number of orders and their gross GMV, gross merchandising volume that they put through the platform. And as they grow, they pay less per unit, but they pay more as they grow. And what we then follow that through was a program of improvements around contracts and then account managers and customer success. And then we put in place the basics of best practice that would be preached by companies like Gainsight. So really putting in place the checks and balances in a calendar to make sure our teams take past value delivered credit from the customer and then point them towards mid-contract upgrade or upsell to new products. So our DRR is being driven hugely by upgrades in plans because our customers are getting bigger on the platform. And the number that sort of cites that, which gives us confidence for the future, is in 2019, we processed $3 billion of orders through the platform. In 2020, that went up to $4.4 billion. So that gives us lots of headroom. So if you think of our annual recurring revenue as a percentage of the total GMV through the platform, we've got lots of headroom now to chase through. And more importantly, the contracts are in place, the teams are in place. Customers aren't surprised when you let them know, hey, congratulations, you've grown. Here's your new plan.
Yep. On a weighted average across
that takes a lot of work.
It does. On a weighted average across the full customer base and $4.4 billion of GMV processed last year, about what percent of that do you take?
We take, at the moment, I think we're 0.7, 0.8%, I believe.
Yep.
I haven't actually looked at that, but yeah, it's about 0.7, 0.8. It's a moving feast, and we've obviously got to take into account discount clawback as well when you're getting into the first year and the deals that are done by salespeople there. But I think we're at about 0.7, 0.8%.
And sorry, that's probably a bad question I asked you because it's hard to sort of calculate that average. You have some people paying more, some people paying less based off volume. Yeah. So a better question might have been, in 2020, when you look at your total revenue, what percent came from the flat SaaS fee versus the GMV percent?
I don't have that figure.
You're not sure?
I'm not sure. I don't have that figure.
Yeah, I mean, this is an interesting trend we're seeing, right, in SaaS companies. Some of the higher valued SaaS companies right now, we call SaaS Plus, have this combined model. And one of the things I'm curious about is which is actually driving more growth, the percent of GMV model or the SaaS fee and traditional expansion model.
So I'm just looking into it now as we speak, just on the scorecard, and expansion in the quarter. So this quarter is running at 140%. So that's a good indicator for, and that's growth this quarter over last quarter. And then if I look at the plan for the year, so we've got 25 million of R to get to in terms of total R. So I've got to add 7.2 million of net R at the end of the year, by the end of this year, of which 2.2 million will come from expansion. So it's very, very important for us. And it's a key area of investment. So when our head of revenue, Nick Shaw, comes to us and say, I want to invest in more salespeople, more CS people, we typically are looking very, very closely now at more CS people. In other words, the retention and the upgrade and the expansion, because it's a lot more cost efficient to go after $1 there. But obviously we're growing and investing heavily in the new business teams as well.
And to hit that 7.2 million in net new target, right? 2.2 million is going to be expansion. How much do you think your processing volume will hit in 2021?
We think, well, it's growing. It grew last year, which is quite exceptional, just over 60%, or sorry, 58%, I think it was.
Yep.
And we expect this year to sort of normalize a little bit down to about 40% growth we expect this year.
So 5.2, 5.3 billion, something like that.
About that, but that's we are assuming and planning that the lockdown that's in place in the markets that we operate in will start easing around sort of July, August.
Mm-hmm.
But obviously that's because the lockdown has driven a lot more growth.
Yeah.
And I've got a lot of customers who are traditional merchants. They were doing really well online, maybe using platforms like Magento. They got hit by COVID. They shut down stores. They literally repackaged their business to go 100% online. They got rid of Magento. They moved on to Shopify, and now they're growing like guns, but completely different cost base. And as a result, very, very different businesses. So it's been quite interesting to see that transformation in the market in the last year.
Derek, let's go back to those CS folks and how you're thinking about expansion. Are you putting quota targets to CS reps?
Yes. So they have 2 buckets. They have in the territory that they run, or the named accounts that they run. We have CS reps split into 2. We have technical account managers that are all around adoption, and then we have account managers that are all about contract renewal, negotiation, past value delivered. So they're the 2 roles. And both of them have a commission plan, which is based on churn, because they've got a goal of getting, retention goal, and then $1 retained revenue figure to get to. So we give them 2 bucket plans, and then we allow them with management to navigate the nuances that occur on a per account basis. But they don't have a hard number to get to.
Yeah.
We haven't done that because I tried that in the past, and it resulted in some behaviors that were not opportune.
Yeah, the CS rep focusing too much on selling, basically.
Correct, and then they make decisions for the short term, and it does not good outcome for lifetime value.
Yeah. Okay. Let's go back to the folks that do carry quota. I'm sure you have account executives. How many quota carrying reps do you have?
We have currently now 8 account reps, of which 4 are new, and our ramp time for each new rep is 6 months. By design, because that's how complex the product is. But we've got 8 at the moment. I would say 6 are fully ramped because we just hired 2 literally in the last two months. 6 are deployed in the US, based in Austin, Texas, and 2 are in the UK. Average ACV, so annual contract value per month that we expect from each individual head is $75K minimum.
Mm-hmm.
So that's their sort of floor.
So that's about 900,000 in new ARR added per year if they're effective at fully ramped.
About that, but when you look at the fully loaded cost of each AE, we're running at about 580. When you take in count your BDO or your cost of pipeline, and you look at all of the people that you need to feed a new AE, because we run a territory model. Mm-hmm. We're stretching for 1.2, although we want everyone to hit the plan and go back to their spouse and celebrate success. So we've got it at 900. Mm-hmm. But like 1.2 is where we want to get to, because our margin is an area of improvement as a business now that we're going through this phase, and we're looking for 3 to 4 points improved margin in the next 18 months.
Yeah,
and that's one of the levers that we'll be pulling, and more robust discounting control and all of the tightening that you would expect once you get product market fit.
And Derek, did I hear you right? You said your all-in cost for an AE is something like $540,000 a year.
Yeah, so that's globalized. It goes up and down a little bit with regards to that's in dollars. Yeah, so it's slightly different cost base in the UK, dollars. But yeah, so that's each AE has a business development rep. Each AE has an allocation for marketing in terms of the number of leads that are going to come to them, and they'll get them from inbound, which are our number one channel. They get an allocation from the partner teams, because obviously that's a very, very healthy contributor of leads. And then each AE has to go out there and develop their own leads through their own territory. We have a territory model in place, which we're expanding. And then you've got other costs that are associated with each AE. So it's really an allocation model from other departments in, and it just gives us we do that because all territories are not equal. So I might have sort of West Coast in the US, California, that the drag along cost there for the AE sort of support with the opportunity that's in market support a much higher quota, although we leave it at 900, but we expect a lot more. Whereas if I go to other places in the US or other places in the UK, they're not as rich. So we're looking for a different type of unit economic profile from those regions. So we might put in less experienced AEs into the newer, more emerging territories.
Mm-hmm. Talk to me about full team size today. How many folks?
We're at about 100. We're at 112 as of this morning, and we're running a sort of sustainable growth profile. So what I mean by that is, as I said earlier on, we're shooting for 40% R growth this year, and we have a plan to get to about 180 people by the end of the year. So it's quite an aggressive ramp. The two main areas of investment are the go-to-market teams, but also engineering. And I'm not necessarily building new features out because we've got a very big platform. I'm going deep and focusing on quality, workflow optimization, automation, and better lowering the cost of integration from other platforms to me. So it's more of an evolution play.
Now, talking about capital before we wrap up here, I think you guys did a $23 million round in December. Is that right?
$33 million, yeah.
33.
Yeah.
So what's that mean fully raised, all in? How much has the company raised?
We've raised 71, I think, in total since the company was started in 2008. Mm-hmm. But since my tenure, I essentially relaunched the business in 2017. Mm-hmm. That brings us to 39 million. That's the way I look at it in terms of when we hit the reset button. And then, so of the 33 million, last year we reached break-even profile, so we weren't burning any cash, which was a big...
Oh, congrats. Which was huge.
that was a huge goal for us to get to. And so we're just managing that, hence the sustainable growth. I could have gone for higher growth, but I would have burnt more, and I wasn't comfortable with that. I didn't want to go back to high burn profile. So of the 33 we raised, we're going to deploy a third of it into working capital improvement into the business. We're going to keep a third of it aside for some acquisitions that we're looking at, and we'll keep a third for a rainy day in the bank, just to make sure that, you know, if something really horrible happened, we would be able to survive. So we're at that point now, and we're in really good shape.
Before we wrap up acquisitions, how do you decide who to go after? Walk me through your filtering process.
Yeah, so the criteria is pretty simple. So technical only. So companies that have really good product, but not necessarily the cost of anything else. So engineering teams. I'm looking for a break-even profile. They can't be burning cash. Preferably, I'd like pre-configured proof of working with my platform and adding value to the customers. And then the last one is skills. I'm looking for people who've got the skills in these acquisitions that I need to execute in the future. So I've got that filter. Got about 12 candidates, and we're just going through them, looking for value, and deploying that capital in a way that keeps my new investors happy.
That's great. And when you raised $33 million back in December, what valuation did you raise at?
Pre-money 105. When I joined, the company was worth 8.
So I hope you carved out a nice equity slug for yourself when you joined.
I did. It was a distressed asset at the time, and I put a little bit of money in. But yeah, I did two things. I got a chunk for myself, and I made sure there was a chunk for the team, the future team. So the first 100 employees are very well represented. And I'm just on a podcast, Lara. No, I don't want to. Thank you very much. Sorry about that.
No, you're good. This is great. Healthy valuation. Put your own money in. Took care of your team. You're doing all the right stuff, Derek. Let's wrap up here with the famous 5. Number 1, favorite business book.
I don't have one at the moment. I'm sorry. I would say one thing. I've really got a lot out of Mark Carney's REIT lectures on BBC podcast, or, you know, if you just look up REIT, the REIT lectures. Mark Carney, who's the ex-Bank of England governor.
The REIT lectures. We'll have to check that out. Number 2, is there a CEO you're following or studying?
Frank Slotman of Snowflake, because he's European. He's older than me. His average tenure is 6 years, and I've been here at Brightpearl 4 years. But his playbook's very interesting, so I've been studying him. Definitely.
It's fascinating. I mean, there's this breed of CEO like Frank, like you, where there's a company that's VC backed that maybe isn't growing as fast as they need to. One of you guys come in, right? You take it to the moon, and hopefully are IPOing 2 or 3 years later. Is that the path you see for Brightpearl?
Yes. No,
Yeah.
we're on it. We're in a hot space in a category that's huge, and we've got a really good path. And now we've got a partner that can give us fast access to distribution. In other words, new customers.
Yep.
And so, yeah, we're still independent. Obviously, that was a minority round we did, and that was very important for us.
Yep. You're talking about the 33 million you raised was minority.
Yeah.
Yeah. Number 3, what's your favorite online tool for building Brightpearl?
Well, it has to be Zoom. It's not my favorite, but it's most. I wouldn't be here without it. So I'm sorry. I know that's a boring answer, but it's Zoom.
You're good. Number 4, how many hours of sleep do you get every night?
Oh, I'm 8 to 9.
Love that. And what's your situation, Derek? Married, single, kids?
Married, 2 kids. One's a teenager, 14. The other one's 12. And they're loving lockdown. Not.
And how old are you?
I'm 52.
52. Last question. What's something you wish you knew when you were 20?
Oh my God. I would have loved to really understood at depth the engineering world, and in particular how to get visibility and understand efficiency levels within engineering. I'd love you to do a show about engineering, not the business side of the house. I'd love someone to do the other side of the house and really drill into the nuances around engineering and the tech stack. That would be super valuable.
Well, watch this, Derek. Guys, if you're listening right now and you're an engineer, I'm not the right host for that show because I don't know the right questions to ask. But if you're listening right now and you're an engineer and you're also entertaining like me, right? And you're fun like me, you're good looking like, no, I'm just kidding. I'll pay you $1,000 a month to launch this podcast. Reach out. I'll pay you $1,000 a month to launch this podcast for folks like Derek. In the meantime, guys, there you have it. Brightpearl up to $18 million in terms of run rate, growing nicely. 4.4 billion in GMV through the platform last year as they continue to scale with their team of 112 people. $33 million raised last year at $108 million pre-money valuation. Derek, thanks for taking us to the top.
Always a pleasure, Nathan. Cheers.
One more thing before you go. We have a brand new show every Thursday at 1 p.m. Central. It's called Shark Tank for SaaS. We call it Deal or Bust. One founder comes on, 3 hungry buyers, they try and do a deal live, and the founder shares back-end dashboards, their expenses, their revenue, ARPU, CAC, LTV, you name it, they share it. And the buyers try and make a deal live. It is fun to watch every Thursday, 1 p.m. Central. Additionally, remember, these recorded founder interviews go live. We release them here on YouTube every day at 2 p.m. Central. To make sure you don't miss any of that, make sure you click the subscribe button below here on YouTube, the big red button, and then click the little bell notification to make sure you get notifications when we do go live. I wouldn't want you to miss breaking news in the SaaS world, whether it's an acquisition, a big fundraise, a big sale, a big profitability statement, or something else. I don't want you to miss it. Additionally, if you want to take this conversation deeper and further, we have by far the largest private Slack community for B2B SaaS founders. You want to get in there. We've probably talked about your tool if you're running a company or your firm if you're investing. You can go in there and quickly search and see what people are saying. Sign up for that at nathanlatka.com/Slack. In the meantime, I'm hanging out with you here on YouTube. I'll be in the comments for the next 30 minutes. Feel free to let me know what you thought about this episode. And if you enjoyed it, click the thumbs up. We get a lot of haters that are mad at how aggressive I am on these shows, but I do it so that we can all learn. We have to counter those people. We got to push them away. Click the thumbs up below to counter them and know that I appreciate your guys' support. All right, I'll be in the comments. See ya.